Today, we expose what the government, the major estate agency chains, and the property portals are working very hard to keep out of the headlines. Across the United Kingdom in May 2026, 8 specific regions and sub-regions are already in a property price crash. Not a slowdown, not a correction, but a genuine, measurable, multi-month decline that has wiped tens of thousands of pounds off the average home in some of the wealthiest parts of the country. The official data is no longer ambiguous. The House of Commons Library confirms that as of May 2026, house prices fell in London, the South East, and the South West. ONS data, released for February 2026, confirms London prices fell 3.3% in 12 months, the 7th consecutive month of annual decline, with a brutal 1.9% drop in a single month. The Halifax Index for April 2026 has gone further, recording the South East down 2.0% year-on-year, and London down 1.4% year-on-year. And Knight Frank, one of the major property agency chains that has every commercial incentive to talk the market up, has just been forced to halve its 2026 UK forecast from 3% growth down to just 1.5%, warning the market is going to keep falling in the coming months. The trigger? The Iran war, which began on February 28, 2026. Within days, swap rates surged to multi-month highs, banks withdrew over 1,500 mortgage products in under a fortnight, and 2-year fixed mortgage rates climbed from 4.8% to around 5.5%, peaking at 5.9% on April 7th. The Bank of England, widely expected to cut in March, instead held at 3.75%. Economists at the bank have now abandoned their 2% inflation target by spring 2026, conceding inflation will run higher than expected. The cuts the market priced in have not arrived. The crash is now visible on regional dashboards. We've spent days digging through ONS Land Registry data, Halifax indices, Zoopla rankings, Bank of England rate decisions, and Knight Frank forecasts to identify exactly which UK regions are bleeding the worst. The pattern is unmistakable, the data is clear, and the implications for British property over the next 18 months are catastrophic for some areas, opportunity for others. But before we get into it, if you own property in any of these regions, if you're about to remortgage, or if you're a buyer wondering whether 2026 is finally the year, hit that subscribe button right now. We're British Front Media, and the property establishment has every commercial reason to keep the bad news out of the spotlight. We have you. Every subscriber, every share, every comment forces the truth higher up the algorithm. So subscribe. Drop a comment with your region. Let's expose what's really happening. Region 8, Outer South East, Surrey, Berkshire, Buckinghamshire. Let's start with one of the regions that political analysts insist is stable. It isn't. Q1 2026 data confirms the Outer South East saw a drop of 0.7% year-on-year, and the trajectory has worsened sharply since the Iran war. The commuter belt that powered 3 decades of relentless price growth has been crippled by the same forces hitting prime London. Mortgage rate shocks pricing out the high-earning professional buyer, return-to-office mandates killing remote worker demand, and a stamp duty regime that punishes the very middle-income family the region was built for. Knight Frank's commercial interest is to talk the market up, and even they have halved their forecast. Region 7, East of England, Cambridge, Hertfordshire, Essex. The East of England has been quietly underperforming for over a year, with average prices remaining below 2022 levels. Cambridge in particular has been hammered by an affordability ratio that simply broke when mortgage rates exploded. The Stansted commuter towns of Bishop's Stortford, Saffron Walden, and Harlow have seen for sale inventory rise sharply across early 2026, and the broader East has joined the South in registering more buyer inquiry declines than rises. Zoopla's data confirms buyer inquiries are down across all areas compared to last year, with the largest declines in the North East and West Midlands. But the East's drop is among the steepest in absolute terms relative to its starting price level. Region 6, South West England, Bath, Bristol, Bournemouth, Devon, Cornwall. The South West is the 3rd English region the Land Registry confirms is in annual decline. ONS data shows the South West joining London and the South East as the only regions registering an annual fall in February 2026. The drivers are unique to the region. The second home tax surcharge has gutted demand for Cornwall and Devon. The holiday let pivot has been blocked by new regulations, and Bristol's tech-driven price boom has reversed as startup funding dried up. Bournemouth, which we've covered in earlier scripts, sits at the heart of this collapse with time to sell stretched past 48 days and 12% price cuts now standard. Region 5. South East England, Kent, East Sussex, West Sussex, Hampshire. Halifax's most recent index for April 2026 confirms the South East as the worst performing English region, with prices down 2.0% year-on-year, bringing the average to £383,044. The headline number disguises far worse damage in specific zones. Hastings, Worthing and Brighton have each recorded individual annual declines well above the regional average, with Hastings down 2.6% on Zoopla's index and Brighton's ONS figure showing a 3.2% annual fall. The coastal SE markets are particularly exposed because they absorbed massive London migration in 2020 to 2022, and that capital flow has now reversed completely. Region 4. London suburbs and outer boroughs, Croydon, Bromley, Newham, Barking and Dagenham. While prime central London has captured the headlines, the outer London boroughs are quietly bleeding too. The City of London is down 11.2% year-on-year, but Zoopla's index shows London and the South East both at minus 0.2% on its own measure, with more homes for sale giving buyers greater choice. A measured statement that hides street-level damage running far higher. In some outer boroughs, the surge of former rental properties hitting the sales market, driven by the landlord exodus we've covered in previous videos, has flooded supply at exactly the moment demand evaporated. The result is properties sitting for 3, 4, 5 months with no offers above 90% of asking. Region 3. Prime central London, Westminster, Kensington and Chelsea, City of London. This is the worst affected major zone in the entire United Kingdom. The official ONS Land Registry data shows Kensington and Chelsea's home mover average price has collapsed from £1,624,000 in February 2025 to £1,452,000 in February 2026, a fall of over £170,000 in 12 months. The City of London is down 11.2% year-on-year, and Westminster, covered in previous British front media investigations, is the worst performing local authority in Britain with annual falls in excess of 12%. The Iran war has frightened off Middle Eastern capital. Non-dom tax changes have triggered a wealth exodus. The Russian and Chinese buyer pools have largely disappeared. And the wider European wealth flow toward London has reversed, with capital now favouring Paris, Milan and Dubai. This is not a correction. This is a structural repricing of London's prime market that may not fully reverse for a decade. Region 2. Aberdeen and North East Scotland, a regional crash that nobody outside Scotland talks about, yet the data is some of the worst in the entire UK. The average Aberdeen home is now worth just £128,000, down 6.4% in a single year per ONS data. Detached homes have fallen 7.2% in 12 months. The Granite City has been losing value since the 2014 oil price crash and is now at the same nominal price as it was in May 2007. 20 years of zero capital appreciation. The renewable energy transition has failed to replace the 18,000 oil and gas jobs that disappeared from the region between 2010 and 2024. Aberdeen is the longest-running housing crash in modern British history, and the rest of the UK should be paying far more attention to it than it does. Region 1. The Iran war hit, composite crash zone. London plus South East plus South West combined. And the single largest housing market collapse playing out in the UK right now isn't any individual region. It's the combined block of London, the South East and the South West, acting in tandem as the wealthiest, most mortgage rate sensitive third of the British property market. Together, these three regions hold properties worth trillions of pounds and house tens of millions of people. The House of Commons Library has formally confirmed all three are in annual decline simultaneously. The first time this has happened outside of a recession since the 2008 crisis. HMRC's transaction data shows UK residential property transactions in February 2026 at 102,000, down 5.6% on a year ago. The repossession data is starting to tick up too. The highest number of repossession sales now in the South East. a leading indicator of mortgage distress that the Bank of England's Financial Stability Committee is watching closely. This is the heart of the British economy in slow-motion contraction. The North-South divide, in numbers, while the South bleeds, the North is thriving. Halifax data confirms the North East rose 4.5% year-on-year to £183,445, with the North West up 3.4% to £248,945. Zoopla's April 2026 index confirms house prices rising fastest in the North East at 3.2% year-on-year, followed by the North West at 3.1% and Scotland at 2.6%. Northern Ireland leads the entire UK at 6.7%. Every individual UK city Zoopla tracks with annual growth above 3% is in Northern England. Burnley up 5.3%, Blackburn 5.2%, Rochdale 5.0%, Liverpool 4.5%, Barnsley 4.3%. ONS data ranks Yorkshire and the Humber as the English region with the highest house price inflation at 3.9%. The mechanism is simple. Northern homes are cheap enough that the mortgage rate shock barely affects them. A £150,000 home in Burnley at 5.5% is still affordable on a median UK wage. A £750,000 home in Sevenoaks at the same rate is not. The Iran war has not changed the income of British workers. It has only changed the price of credit. And that change has disproportionately destroyed the high-priced southern market, while leaving the low-priced northern market untouched. Why this is structural, not cyclical. The drivers reinforcing this crash are all long-term. Non-dom tax changes are permanent. The stamp duty surcharge on second properties is unlikely to be repealed by any government. EPCC requirements for landlords coming in 2030. The Renters' Rights Act. The autumn budget's mansion tax on £2 million plus homes. Wealth exodus to lower tax jurisdictions. And the structural shift in remote work that has decoupled white-collar jobs from city centres. Even if the Iran war ended tomorrow and the Bank of England cut rates next month, these structural forces would continue to pressure southern English property values for years to come. What this means for you. 3 rules for navigating this regional crash. First, if you own in the south, do not panic sell. The data shows southern property is in repricing, not collapse. Halifax still has the southeast down only 2% year-on-year, not 20%. But understand that you cannot expect 2022 prices on a property valued in 2026. Adjust your expectations or hold long-term. Second, if you are buying in the south, this is the best negotiating environment in 15 years. Sellers in southern markets are accepting offers 10 to 12% below asking. Use that leverage. Push aggressively on price, on completion timelines, on fixtures and fittings, on conditions. The market is on your side for the first time in a generation. Third, if you have the flexibility, follow the data and look north. Burnley, Blackburn, Rochdale, Liverpool, Barnsley, South Tyneside, Pendle. These are the markets showing real growth right now. Yields are stronger, prices are rising, and the regulatory regime is identical to the south. You're getting north of 3% capital appreciation against the south's negative numbers. If this video changed how you see the UK property market, hit that subscribe button one more time. Drop a comment telling us your region and what your local market looks like on the ground. And subscribe to British Front Media because we're doing this every single week. New investigation, new exposé, new truth the property industry doesn't want you to hear. Until next time, read the data, question the headlines, and protect your home.